Bitcoin just crashed 47% from its all-time high. Michael Saylor's strategy is sitting on $6.4 billion in unrealized losses. The largest corporate Bitcoin treasury on Earth is underwater for the first time in its history. And yet, the man betting his entire empire on Bitcoin just revealed something on his earnings call that changes everything about how we should think about this moment. What he said contradicts almost every piece of mainstream financial advice you've ever heard. And if he's right, the people panicking right now are making the biggest mistake of their financial lives. I am about to show you the 3 catalysts that will determine Bitcoin's future, why doing absolutely nothing might be your most powerful strategy, and what institutional investors are really doing while retail panic sells at the bottom. This is the Wealth Continuum. Let's break down Michael Saylor's master framework for surviving market chaos. Let's not sugarcoat this. The last 10 days have been absolutely savage. On February 5th, 2026, Bitcoin crashed to $60,062, the lowest level since November 2024. Today, February 11th, we're trading around $67,000. That's a 47% decline from the $126,000 all-time high hit in October 2025. The Fear and Greed Index, deep in extreme fear territory. Over $2 billion in forced liquidations across crypto this week. Bitcoin broke below its 365-day moving average for the first time since March 2022. Here's where it gets really interesting. Remember all those Bitcoin ETFs that were supposed to be the game changer? They're net sellers in 2026. According to CryptoQuant, institutional demand has reversed materially. These same funds that purchased 46,000 Bitcoin this time last year are now dumping coins. And Michael Saylor? Strategy owns 644 Bitcoin with an average purchase price of $76,000. Do the math. With Bitcoin at $67,000, that's approximately $6.4 billion in unrealized losses. The MSTR stock, down 62% year over year, down nearly 80% from its peak after Trump's election victory. Critics are having a field day. Michael Burry is warning about bankruptcy risks. Peter Schiff is blasting Saylor on social media. But here's what everyone is missing. While headlines scream panic, Strategy just bought another 1,142 Bitcoin on February 9th, right in the middle of the crash, for $90 million or at an average price of $78,815 per coin. And on February 6th, during the Q4 2025 earnings call, Saylor didn't sound worried. He sounded confident. What does he know that everyone else is missing? Make sure you're subscribed to the Wealth Continuum because we're about to uncover exactly what institutional players see that retail traders don't. During that February 6th earnings call, Tom Lee from Fundstrat asked the question everyone wants answered: what are the fundamental catalysts that will actually drive Bitcoin's price higher? Saylor identifies 3 pillars. Catalyst number 1, regulatory support. We have the most constructive set of financial regulators in the history of the industry right now, Saylor said. Think about that. The head of the Federal Reserve, Treasury, CFTC, SEC, and the White House now has a digital assets czar. Those 5 things are massive bull flags, Saylor continued. They're all very positive. This isn't speculation. This is policy reality as of February 2026. Catalyst number 2, banking adoption. Saylor talks about the formation of banking credit networks. As large banks and companies like Charles Schwab start allowing customers to trade, custody, and borrow against Bitcoin. When you can walk into a major bank and get a loan with Bitcoin as collateral, that changes everything about the asset's volatility and institutional adoption. Saylor specifically mentioned BlackRock's Bitcoin Volatility Income Fund, launched just before the earnings call. When the largest asset manager on Earth launches a product designed to sell Bitcoin volatility and generate income, they're telling the market something critical. Bitcoin is stable enough to build sophisticated financial products on top of. This creates a feedback loop. Less volatility attracts more institutional capital. More capital brings more infrastructure. More infrastructure reduces volatility further. Catalyst number 3, financial innovation. Look at what BlackRock is doing. Look at Strategy's STRC Treasury Credit Instrument. Look at the entire ecosystem of financial products being built on Bitcoin. As Saylor put it, fundamentally, the industry is going to move forward because of enlightened regulation, engaged thoughtful banking, and then innovative finance. That's what we're seeing right now. Now I know what you're thinking. Great long-term catalysts. But what about the next 6 months? What about my portfolio that's down 40%? Pete Christensen from Citi asked Saylor exactly that. And his answer reveals something profound about strategic thinking that goes against every investor instinct. Pete Christensen asked about macro uncertainty. If the Fed becomes less independent and more tolerant of fiscal dominance, how does that change strategy's framework? Here's Saylor's answer. We try to be very reactive to market conditions. We don't try to predict the future. Markets can change in 60 seconds. We can't predict whether the Fed will be hawkish or dovish or what the White House will do. Then he drops the key insight. If Bitcoin grows 30% per year, strategy is a $40 to $50 billion company growing 30% per year by doing nothing. That's the default case. Read that again. By doing nothing. Most investors think they need to constantly trade, constantly reposition based on the latest Fed comments. Saylor is saying the opposite. In a world where Bitcoin is the base case growth engine, the option to do nothing is actually the most powerful tool you have. You don't need to time every macro shift. You just need to let the asset compound. And here's the discipline. When the market offers you attractive terms to raise capital, you take it. When it doesn't, you wait. When strategies stock trades at a premium to net asset value, meaning the market values MSTR shares higher than their Bitcoin, they issue shares and buy more Bitcoin. It's accretive to shareholders. When their stock trades at a discount, they wait. They've got $2.25 billion in cash. No debt maturities until 2028, 2030. They can afford patience. As Saylor says, you can't control markets changing in 60 seconds. What you can control is whether you issue dilutive equity at the bottom or accretive equity at the top. Right now, with Bitcoin at $67,000 and Strategy's average cost at $76,056, they're underwater. Their stock trades at only a slight premium to NAVO. So what are they doing? Mostly waiting. They made a small purchase of $1,142 BTC during the dip, but nothing compared to the billions deployed when conditions were better. They're not panic selling. They're not liquidating to cut losses. They're sitting on 714 of our 644 Bitcoin and waiting for better opportunities. Could you sit still with $6.4 billion in unrealized losses? Could you resist the urge to do something when critics predict bankruptcy? Drop a comment. Is the hardest part of investing the discipline to do nothing when everyone screams at you to act? Andrew Hart from BTI asked what Saylor tells large institutional investors new to Bitcoin, especially during high volatility. Here's the framework. Time horizon. Minimum 4 years, preferably 10 years. Bitcoin's a capital investment. Your time horizon needs to be minimal 4 years. Look at the 200-week simple moving average, the 4-year average, not the daily price, the 200-week moving average. Invest with a 4-year dollar cost averaging approach. And you really want to hold for a decade. Then he gets direct. If you can't stomach waiting a decade with no cash flow, and if you can't stand the volatility, then buy the credit instead. Investor categorization. Saylor breaks down 4 types. Type 1, don't believe in Bitcoin, don't buy anything. Type 2, Bitcoin maximalist wanting 2x exposure, buy MSTR equity. Type 3, believe in sovereign, censorship-resistant generational wealth, buy Bitcoin directly, self-custody. Type 4, think Bitcoin looks compelling but need liquidity or CA on handle volatility. Start with Treasury credit instruments like STRC. This isn't just product positioning. Saylor acknowledges different investors have different needs, risk tolerances, and time horizons. Bitcoin can serve all of them. The key is matching the instrument to the objective. Here's what makes this framework powerful. Right now, with Bitcoin down 47% from peak, your response should be completely different depending on which investor type you are. Type 1, and don't believe? This volatility confirms it. Type 4, exploring through Treasury credit? This volatility is exactly why you made that choice. Type 3, holding for generational wealth? This is literally just noise on a decade timeline. Type 2, with leveraged MSTR exposure? This is the pain you signed up for in exchange for amplified upside. The framework helps you understand, am I experiencing appropriate pain for my thesis, or am I in the wrong position? If you're learning to match your position to your actual conviction, hit that subscribe button. That's what we do at The Wealth Continuum. Let's zoom out and look at where we actually are as of February 11th, 2026. Let's get grounded in reality. Price, action, and market structure. Bitcoin current price, $67,000, all-time high. $126 plus, October 2825. Recent crash low, $62. February 5th, 2026. Total drawdown from ATH, 47%. Trading range this week, $65,800 to $7,400. Institutional holdings. Strategy owns 714,644 BTTC. Average purchase price, $76,056. Total cost basis, $54.4 billion current market value, $47.9 billion unrealized losses, $6.4 billion recent purchase, 1,142 BTC on Feb 9 at 78,815. AVG market sentiment and technical, fear and greed, index 20-100, extreme fear. Bitcoin broke below 365-day moving average $2 billion plus in forced liquidations this week. Bitcoin ETF flows, net negative, sellers in 2026. Total crypto market cap, a $1.3 trillion MSTR stock. Performance, down 62% year over year, down part of 80% from post-election peak, Novu 2024. Trading at 1.10x. NAV multiple market cap reflects deep skepticism about Bitcoin treasury strategy. This is the environment. This is the reality. It's not pretty if you're looking at short-term price action. But here's what else is happening that most people aren't paying attention to. On February 6th, the same day as the earnings call, Strategy announced something called the Bitcoin Security Program. This is a collaborative initiative they are leading to develop quantum-resistant security measures for Bitcoin before quantum computing becomes an actual threat to cryptographic security. Now, is quantum computing going to break Bitcoin's encryption tomorrow? No. Experts estimate we are 10 to 20 years away from quantum computers being powerful enough to threaten Bitcoin's SHA-256 cryptography. But here's the point. Strategy is thinking in decades, not quarters. They're not worried about the next earnings report or the next Fed meeting. They're planning for Bitcoin's long-term evolution as technology changes. They're building institutional trust that Bitcoin is not just a trade for this cycle. It's a multi-generational asset that will adapt and survive technological change. This is the kind of long-term thinking that separates real institutional players from traders. And meanwhile, Saylor continues to publicly state his goal, eventually acquire 1 million Bitcoin. That would be nearly 5% of Bitcoin's total fixed supply of 21 million coins. An absolutely massive position that would make them basically untouchable as the largest corporate holder. Are they going to get there at these prices? Probably not immediately. They're waiting for better opportunities. But the goal hasn't changed. The vision hasn't changed. The framework hasn't changed. Let me ask you, do you think Saylor's goal of owning 1 million Bitcoin, 5% of all Bitcoin that will ever exist, is brilliant strategic vision? Or is it reckless over-leveraging that's going to end in disaster? Is this man a generational visionary who's positioning for the next decade of financial infrastructure? Or is he over-leveraged and headed for one of the most spectacular corporate failures in history? I genuinely want to hear your take. Drop it in the comments below. No wrong answers. I want to know what the Wealth Continuum community actually thinks. All right, let's bring this full circle and talk about what you should actually take away from all of this. Because information without application is just entertainment. Takeaway number 1. The fundamentals Saylor outlined are stronger than they've ever been. Think about this carefully. Regulatory support. We have the most constructive regulatory environment in Bitcoin's history. The Fed, Treasury, SEC, CFTC, and a White House digital assets, CSAR, all publicly supporting digital asset innovation. Banking infrastructure? Being built right now. Charles Schwab working on custody and lending. Major banks developing Bitcoin credit networks. This isn't speculation, it's happening. Financial innovation. BlackRock launching sophisticated volatility products. Strategy creating treasury credit instruments. The entire derivatives and structured products ecosystem being built on Bitcoin's foundation. Yes, the price is down 47% from the peak. Yes, sentiment is terrible. Yes, ETFs are net sellers right now. But the catalysts that will drive long-term institutional adoption, the infrastructure that makes Bitcoin part of the mainstream financial system, those are accelerating, not slowing down. The price is temporary. The infrastructure is permanent. Takeaway number 2. The best strategic posture in volatile macro environments is often doing nothing. This is so counterintuitive that most people can't accept it, but it's true. If Bitcoin compounds at 30% annually over the long term, which is actually below its historical average since inception, then your default case is winning. You don't need to do anything else. You don't need to trade every swing. You don't need to predict every Fed decision. You don't need to time the bottom or the top. You just need the discipline to let compounding work. And that means having the conviction to sit still when everyone else is panicking. Strategy demonstrates this perfectly. They raised capital and bought heavily when MSTR traded at big premiums to NAVO when market conditions were favorable. Now that the stock trades near NAVI, they're mostly waiting. They made a small opportunistic purchase during the crash, but they're not forcing it. They're playing the long game. And the long game rewards patience. Takeaway from 3. Match your position to your conviction and your time horizon. This is critical. If you truly have a 10-year time horizon and you believe in the 3 catalysts Saylor outlined, then this drawdown is either meaningless noise or it's an opportunity. It's not a reason to panic, but if you don't actually have a 10-year horizon, if you need this money in 2027, or you're planning to buy a house in 2028, then you should not have been in a leveraged Bitcoin position to begin with, and that's okay. Not everyone should be a Bitcoin maximalist. There are other instruments for different risk profiles and time horizons. The mistake is being in a 10-year position with only 10-month emotional tolerance for volatility. That mismatch is what gets people destroyed. They enter with conviction, but exit in panic. Figure out which of Saylor's 4 investor types you actually are. Then position accordingly. Takeaway number 4. We're not at the end of Bitcoin's institutional adoption. We're at the beginning. Saylor mentioned this on the call, and it's worth repeating. There are only 4.4 million wallets globally with $10,000 or more worth of Bitcoin. Compare that to nearly 1 billion accounts globally with $10,000 or more in stocks, bonds, or cash. The world hasn't really adopted Bitcoin yet, not even close. We're still in the very early innings. The regulatory framework is now supportive. The banking infrastructure is being built right now. The financial products are launching. The custody solutions are being developed. And the institutions that understand this framework, strategy, BlackRock, sovereign wealth funds, pension funds that are just starting to explore this space, they're accumulating quietly while retail panics over short-term price volatility. Look, I'm not going to sit here and tell you that Bitcoin is guaranteed to hit $100,000 or $200,000 or $500,000. Nobody knows that. Anyone who claims to know is lying to you or selling you something. What I can tell you is this. The framework Michael Saylor outlined on that February 6th earnings call, regulatory support, banking adoption, and financial innovation, those 3 catalysts are real. They're measurable, they're verifiable, and they're happening right now in February 2026, while everyone is panicking about price. The question isn't whether Bitcoin will recover. Assets don't recover. They respond to fundamentals and market structure over time. The real question is whether you are thinking in the right time frame. Are you trading daily price movements, trying to catch bottoms and tops, stressing about every red candle? Or are you positioning for a multi-year structural shift in how global finance treats digital assets? Are you reacting emotionally to fear and greed? Or are you following a coherent framework based on institutional adoption catalysts? Are you doing something, anything, just to feel active and in control? Or do you have the discipline, the conviction, and the patience to do nothing when that's actually the most powerful move? Because that's what separates long-term wealth builders from short-term traders who get shaken out at every bottom. I want to hear from you. Based on everything we've covered in this deep dive, do you think Saylor's 3 catalysts, regulatory support, banking adoption, and financial innovation, are enough to drive Bitcoin to new all-time highs over the next few years? Or do you think we're headed for an extended bear market that could last years? And do you agree with his 4-year minimum, 10-year hold framework? Or do you think that's too conservative for crypto? Maybe you think it's not conservative enough. Drop your honest thoughts in the comments below. I read every single one, and the best insights often come from the community discussion. And if you got real value from this breakdown, if understanding how institutional players think during market chaos helped you gain clarity on your own position, do me a favor, hit that like button so more people can find this analysis, and share it with someone in your life who's panicking right now and needs to hear this framework. This is the wealth continuum. We don't chase hype. We don't panic at crashes. We build frameworks that separate long-term wealth builders from short-term traders who get shaken out. Make sure you're subscribed with notifications turned on, because we're going to be tracking exactly how these three catalysts play out over the coming months. We'll be watching regulatory developments, banking infrastructure launches, and new financial products. We'll be updating you on strategies, moves, institutional flows, and market structure changes. Thanks for watching. Thanks for being part of this community, and I'll see you in the next one.